Hello, friends. Welcome back to Social Security Post, where we break down the money issues that matter most to Social Security recipients and retirees. Let me ask you this. Have you ever felt that no matter how long you worked or how hard you tried to save, you still pay more taxes than people who seem to have all the money in the world? It is frustrating, but it is not your imagination. The truth is, wealthy people and business owners often pay less in taxes even while earning more money, and they do it legally. That is because the tax system rewards certain activities like running a business or investing instead of working only for a paycheck. And while that might sound unfair, it is the reality. You might think none of these rules apply if you are living on Social Security, but you could still benefit if you ever pick up a side hustle, rent out a property, or start a small hobby business to supplement your benefits. In today's video, I will explain 5 of the biggest tax breaks and rules that wealthy people use in clear language so you can see what options might be out there even in retirement. This is not personal tax advice. You should always check with your own tax professional. But by learning about these strategies, you can better protect every dollar you have worked so hard to earn. If you find this kind of information valuable, please take a second to like this video and subscribe to Social Security Post so you do not miss out on ways to make the most of your retirement. Let's talk about one of the main reasons wealthy people and business owners pay less in taxes than folks with a steady paycheck. Many of you watching rely on Social Security, but some of you might still work part-time or think about picking up a side hustle to help manage costs. That is why it is important to know how different kinds of income are taxed. If you work as an employee, which the IRS calls a W-2 worker, every dollar you earn is taxed before you even get to use it. Taxes come out for federal programs plus Social Security and Medicare right away. For example, someone earning $100,000 in a year, just as an illustration, might pay around $14,000 in federal taxes plus $7,650 in Social Security and Medicare taxes. That leaves about $79,000, which then has to stretch to cover things like phone bills, car payments, or travel. Now think about earning the same $100,000, but through a small business or an LLC, even in retirement. In that case, you can pay your business expenses first before taxes. If you needed a computer, a phone, or even mileage for the car you use in the business, those costs could be deducted up front. If you had $40,000 in business expenses, that means you only pay taxes on $60,000 instead of the entire $100,000. It goes deeper too. Business owners can split what is left into salary and profit and only pay Social Security and Medicare taxes on the salary portion. A W-2 employee pays Social Security and Medicare taxes on every single dollar earned with no break. That is why people with businesses often keep more of their money. Why does this matter if you are retired on Social Security? Because if you ever decide to run a small side business, even something simple like crafts, part-time ride sharing, or consulting, you might be able to set up an LLC to keep more of that extra money, which can help you stretch your Social Security benefits. Stay tuned because there is a lot more to break down in simple language so you can understand how these tax rules really work. Now let's look at one of the first big tax breaks that wealthy people use: ordinary and necessary business expenses. The IRS has rules that say you can subtract the cost of running a business from your total income before you ever pay taxes on what is left. This is called deducting your ordinary and necessary expenses, and it is one of the most powerful tools in the tax code. Here is what that means in plain language. If you have a legitimate business, and yes, even a side hustle counts, you get to pay for things you truly need to run that business before sending money to the IRS. This could include a portion of your phone bill, a portion of your car if you use it to deliver products, or part of your home internet if you use it to market your services. These are considered ordinary because they are common for businesses, and necessary because they are directly connected to earning money. Let me give you an example. If you make jewelry and sell it online while retired and you have an LLC, you could count the materials, the tools, and part of the phone or computer you use to handle orders as business expenses. Those costs come out before taxes are calculated, saving you money. Accountants can get creative, sometimes very creative, about what is considered ordinary and necessary. There have been cases where business owners wrote off fancy cars, arguing they needed them for marketing or for creating a professional image. While that might not apply to everyone, it shows how broad these definitions can be. Why does this matter to you if you are on Social Security? Because even if you only run a tiny business part-time to help supplement your monthly benefit, you could still qualify for ordinary and necessary deductions. That means every extra dollar you make could go further if you structure it correctly. And if you report a loss, you might even be able to use that loss to offset other taxable retirement income, depending on your situation and the IRS rule. Just remember, you must follow the rules closely. These deductions need to be truly connected to your business and documented carefully so you do not risk penalties or back taxes later. Working with a tax professional can help you stay within the law while saving the most money. We will keep going deeper into these tax breaks so you can learn how to protect every single retirement dollar you work for. Now, let's move on to the second big tax break that benefits the wealthy and can even help retirees who want to invest. This is all about investor tax rates. Here's the deal. If you earn money as an employee, every dollar you make is taxed through a series of brackets. The more you make, the higher the percentage you pay. That is called a progressive income tax. For example, a W-2 employee might pay 10% tax on the first $11,925 of income, then 12% on the next chunk, then 22% on the dollars after that, and so on. That top rate for high earners can go up to 37%. So if you are working for a paycheck, the system steadily takes a bigger bite as you earn more. But if you earn money from investments, such as owning stocks for over a year, you often pay a much lower tax rate. These are called long-term capital gains rates. Right now, that rate can be 0%, 15%, or 20%, depending on your income. And those levels are much lower than the 37% top rate for wages. The rules were designed to encourage people to invest their money instead of just working for it. Why does this matter to you as a Social Security recipient? Because even if you only invest a little, say you put away some savings in stocks or rental property, understanding these lower tax rates can help you keep more of what you make from those investments over time. That could mean thousands of dollars saved. There is another small bonus you might not have heard about. If you invest in treasury bonds, for example, the interest you earn is usually tax-free at the state and local level, even though you still pay federal tax. That is important for people on a fixed income like Social Security because every little bit of tax savings helps stretch your benefits further. So remember, the tax code rewards you if you can make your money work for you through investing instead of relying only on wages. It is worth learning these rules so you can ask better questions of your financial professional and maybe keep more of your hard-earned retirement dollars. We will keep exploring these legal tax breaks in the next section, so stay tuned here on Social Security Post. All right, let's dig into the third major tax break, which is called depreciation deductions. And this one is especially important if you own any rental property or plan to buy one in retirement. Here is how it works in simple terms. When you buy a rental property, you usually pay one price for the land and the building together. For example, say you buy a small house for $250,000, where $50,000 is considered land value and $200,000 is the value of the building itself. Even if the home goes up in value, the IRS lets you treat the building part as if it is losing value over time. That is what depreciation means. The IRS says you can spread that $200,000 of building value across 27 and a half years. That comes out to about $7,200 a year that you can subtract from your taxable rental income year after year. So if you made $10,000 in rent profit, you would not pay taxes on all $10,000. Instead, you would tell the IRS, I should subtract $7,200 of depreciation, and you only pay taxes on $2,800 of taxable income. That is a huge advantage because it means you can put more rent money in your pocket without sending so much to the government. Why does this matter to Social Security recipients? Because more retirees are looking for ways to supplement their benefits, and a small rental property could help. By understanding how depreciation works, you can legally shelter some of that rental income from taxes, making it easier to cover bills and healthcare in retirement. Just remember, you must track and document everything properly, and it is wise to work with a qualified tax professional who understands real estate because the rules can get complex. If you do it wrong, the IRS can charge you penalties later. Depreciation deductions are one reason why owning rental property is such a common wealth building strategy, and one reason why the tax code seems to favor investors hours over workers. In the next section, we will explore an even bigger twist on depreciation that can help you protect even more of your dollars. Stay with us here on Social Security Post as we break that down. Now let's build on what we just learned about depreciation and talk about an even more powerful strategy: accelerated depreciation. This one is especially popular among real estate investors, but it is useful to know even as a Social Security recipient who might rent out a property someday. Normally, you deduct a set amount of your building's value each year, for example, about $7,200 per year for 27 and a half years on a residential property. That is called straight line depreciation. But the IRS also gives you the option to move faster by using what is called accelerated depreciation. Here's how it works in plain English. Let's say you buy a property worth $250,000 and you break out $50,000 for land and $200,000 for the building. Instead of slowly deducting $7,200 per year, you could have a professional do a cost segregation study. That study breaks down your property into smaller pieces, carpets, appliances, fixtures, and allows you to write off much larger amounts sooner. In some cases, you might be able to deduct $35,000 in the first year alone instead of just $7,200. That means you would show a paper loss on your taxes, even though you might still have money in the bank from your rental income. Why does that matter? If you have $10,000 of rental profit, but a $35,000 depreciation deduction, you could report a $25,000 loss. That paper loss could then offset other income like a small side business or part-time work income, depending on your tax situation. But there are a couple of rules you should know. If your overall income is more than $100,000 a year, you might not be able to use that loss right away unless you qualify as a real estate professional or your spouse does. In other cases, you can carry the loss forward to use in future years. Also, if you convert the property to a short-term rental like Airbnb, the tax code gives you a bit more flexibility to use the loss against other active income. It might sound complicated, but the main takeaway is this: wealthy people use accelerated depreciation to protect their income and grow their wealth, and there is no reason you cannot learn these same rules, especially if you own or want to own a rental in retirement. Always work with a qualified tax advisor, because messing up these deductions can lead to big headaches later. But done properly, accelerated depreciation is one of the most powerful ways to keep more of the dollars you worked for. Stick around, because next we will look at one of the biggest tax tools of all, the like-killed exchange, right here on Social Security Post. All right, let's dive into the fifth and final tax break that wealthy people often use. And this one is especially powerful for anyone who owns rental property: the like-kinked exchange, also called a 1031 exchange. Here's the idea in simple terms. Let's say you bought a rental property years ago for $250,000, and today it is worth $500,000. If you sold it, you would normally owe taxes on the $250,000 in profit. That is called a capital gain. But with a 1031 exchange, you can defer paying those taxes by taking all the money from selling that property and immediately buying another qualifying rental or investment property. That way you can reinvest your profits without sending a giant tax payment to the IRS right away. You can do this over and over again, each time selling one property, buying another, and rolling the money forward without paying taxes for years. Some investors even keep doing this for their whole lives. Then, if they pass away while still holding those properties, their heirs might get a step up in property value, which can wipe out those deferred taxes entirely under current law. Why does this matter to Social Security recipients? Because more retirees are looking at rental properties to help cover costs. If you own one already or plan to, a 1031 exchange could let you upgrade to a bigger or better property without losing a chunk of money to taxes, and that means more income for your retirement years. But a 1031 exchange is not something you should try on your own. It has strict deadlines, paperwork, rules, and requirements, so you really need a qualified specialist to guide you. If you mess it up, the IRS will make you pay all the taxes you were trying to delay, plus penalties. Still, this tool can be one of the best ways to keep more of your investment gains working for you, growing your income and security through retirement. And that is what this is all about, making sure you hold on to every dollar you earned instead of giving it away. In a moment, we will wrap up everything we talked about today, so stay tuned here on Social Security Post. Let's bring this all together. Whether you are retired, on Social Security, or working a small side job, one truth stays the same. The tax code is like a rule book. And people with money or people who own businesses learn those rules and play them to their advantage. That is how they keep more of what they earn. Might feel unfair, but it is simply how the law is written. Business owners and investors get to deduct expenses before they pay taxes. They get to shelter income with things like depreciation. They get to roll their profits into new opportunities without paying taxes right away through tools like the 1031 exchange. Meanwhile, workers who earn a paycheck pay taxes first and try to live on what is left. That is why people sometimes say the tax code punishes employees and rewards investors. And in a way it does, but you do not have to feel left behind if you learn about these tools. Even a Social Security recipient can use small side businesses, hobby ventures, or rental property to keep more of your dollars legally. Remember, none of this is about breaking the law or taking shortcuts. It is about understanding how the system works so you can protect your money. Because in retirement, every dollar counts, and what you keep matters just as much as what you earn. Always talk to a trusted tax professional if you are thinking about starting a small business or investing while on Social Security. But do not be afraid to learn and ask questions. The tax code is complex, but once you know the rules, you can play the game too. And that is how you build stability and peace of mind in your retirement. Next, let's wrap this all up with one last reminder here on Social Security Post. All right, friends, let's wrap up what we learned today on Social Security Post. We covered 5 powerful tax breaks that wealthy people and business owners use to protect their income. And even though you might be living on Social Security, some of these tools could help you too if you ever start a small business, do a side hustle, or invest in a rental property during retirement. Here's a quick recap. Ordinary and necessary business expenses let you pay for work costs before taxes. Investor tax rates reward you for putting your money to work. Depreciation deductions let you shelter rental income year after year. Accelerated depreciation gives you even bigger deductions up front. And 1031 exchanges let you roll your profits into new properties without paying taxes right away. These are all perfectly legal tools built right into the tax code. They exist to encourage business activity and investment. And they can work for you if you take the time to learn and follow the rules. That way, you keep more of what you have earned and make your Social Security dollars go even further. If this video helped you understand these complex topics a little better, please remember to like the video and subscribe to Social Security Post so you never miss future tips about protecting your retirement and making your dollars count. Thank you so much for spending time with us today. Take care of yourself, stay informed, and remember, your money matters because you worked for it. See you next time on Social Security Post.